Hey guys, welcome to this new video, and today we're going to talk about financial projections. So in the last one we discussed how investors think about valuation and uh, the way to understand the ranges of for negotiations. So today we're going to do a step further. We're going to talk about how to show the potential of your company, meaning showing that your company can possibly reach millions and millions of revenues. So how do you do financial projections? This is a question that most people, most entrepreneurs don't know how to answer. So today we're going to discuss two main approaches and the mindset you should have to do financial projections. And also I'm going to share with you some tools or some tips on how to do that. So the first of all, there are two main widely adopted methods or approaches to do financial projections. One is the bottom up and the other is the top down. The bottom up is also referred to as inside out, meaning that you estimate the resources you have available and then you project that outside. And the top down, on the other hand, is outside in, meaning that you start from certain data about the market size and the market share you're going to be able to get, so the target in terms of revenues you can achieve, and then you work out what that implies for your organization in terms of cost and everything else. So when should you use one over the other? There are a lot of theories about that, depending on the business model, depending on the type of business, but I would say that the key principle here to understand which one to use for your case is the purpose of the valuation. Meaning that if you are raising capital, then your valuation should be is to get resources to achieve certain goals and achieve certain growth, right? So the outside in should be more feasible for you. On the other hand, if you're doing valuation for internal management, for even exit planning, can be the case when a company already achieved a substantial market share and it's just growing organically, then you may want to use the bottom up. There is like a key difference in the assumption you're making when using either top down or the bottom up. And the difference is if you use the top down, you are assuming that the resources to get to a certain growth path, to get to a certain target in terms of revenues or market share are available and easy to get. It's like saying, I'm going to be able to raise capital across the stage and across the years that it takes me to get to that target. So that's why this could be more suitable in case you are a startup in the process of raising capital. Because if you're able to reach those milestones, then you're going to be able probably to raise capital. That's the main assumption. On the other hand, if you take the bottom up, in this case, it's more used for companies that are growing organically. It doesn't mean that they're not raising capital, they do not use any external type of financing, but it means that they are more focused on using the internally generated cash flows to grow the business. Nonetheless, the main assumption you're doing here is that you are able to sell what you're able to produce in terms of products or service to the market. It's like saying you have a production plant that allows you to produce a certain volume, maximum volume of X, and you're going to be able to sell all that volume to the market. Okay, so now let's try to dive a little bit more into the details of each of the two approaches, and also I will try to make some examples of that. So let's start with the bottom-up or inside-out. So first of all, what are applicable type of businesses or better business models for this type of approach? Well, I would say companies where the revenues are capped, there is a maximum of the potential revenues you can achieve given the size of the organization. Let's make an example: a restaurant, a factory that produces ice creams. If you have a restaurant or a factory, you can produce a certain number of products, or you can serve a certain number of clients with the resources you have available today, with the asset that your company has today. And to achieve larger growth, larger revenues, you probably have to run into investments, meaning that you have to invest in assets or in people. Even if you have a consultancy business, every consultant bills the hour, and the time of the amount of time they have available is capped. Even if they work like 24/7, still there is a maximum to how much they can serve and how much revenues they can drive to the customer from the customers. So now let's make an example with a very simple case that I personally like a lot, an ice cream factory. So let's say you have a production plant that is able to produce 1 million pieces, so 1 million ice creams per quarter, and you're going to be able to sell it for €1 per ice cream. The assumption you're making here is that every quarter you're going to be able to, first of all, reach that volume, but that should be pretty easy. But also they're going to be able to sell it. So that's the kind of assumption you are implicitly doing when doing financial projections. If you want to, get to 2 million turnover per quarter, then it probably means that you have to invest into the production plant to reach like a larger volume of production. And you can most likely it's going to take time. If you're growing organically, it's going to take time to generate the cash to be able to do the investment, or you can go to an external financing source. Still, every time you increase the volume you can produce, you're still putting a cap on the potential revenues, because that's the type of business model you have. That's the type of business you're in. Doesn't mean it's not scalable. Doesn't mean that it cannot reach like a huge turnover. But the growth path is now like the traditional hockey stick. Is more predictable, and it looks like a sort of stair or ladder. And every step is represented by the maximum capability that your organization can reach without additional investment. So this was an example of the bottom up. I would say that this is mainly used for companies that are in business for more years, where the growth potential maybe is not that elevated, where the growth is more organic, and where there is like some history that can help in predicting the future revenues and the future costs. It can be used also for other type of businesses, but I would say this is pretty much the case. If you look in the description here of this video, then you will find a link to a projection spreadsheet that we specifically made for this type of approach. It's free to download, so you can just take a look. It's pretty comprehensive, and I had fun doing it.